Hello friends, James Stevenson back with another edition of Who's Hating Hard on Tesla Today? And we have quite a few haters lined up today to take a look at their tweets since Tesla reported Q3 2022 earnings, and they're accusing Tesla of accounting fraud, as they have been for 4 years now, based on the total amounts they see in OPEX and in SG&A, which is not a very rigorous analytical approach to just point at the totals and say, those don't look high enough to me, so fraud. Let me bring in my co-host Loki. Loki is phoning it in today. He is off to puppy dreamland right now, but you'll be able to keep an eye on him with the Loki cam over here. And let me make sure I get his other ear in the shot here. He is too cute to not get all of his head in the shot. Okay, so the first tweet we have here is from Cubico, longtime Tesla hater, longtime Tesla short seller, on Twitter claiming Tesla revenue and OPEX for the past 5 years by quarter, just showing a chart. But the reason for showing this chart was to retweet Ross Hendricks, another longtime Tesla short seller, longtime Tesla hater, who tweeted outside of Tesla, the last company I saw post greater than 50% unit growth with flat OPEX was Luckin Coffee, which was a fraudulent Chinese company that claimed they were going to sell more coffee in China than Starbucks, and they were inflating their revenue. So that is what these two are accusing Tesla of in these tweets, if you can't put together what they're up to. The next tweet that I have for you is from Stanfill Cap, which is Mark B. Spiegel. He used to have an account where his handle was Mark B. Spiegel until Twitter suspended that account permanently. So now he uses his backup account, which is the name of his hedge fund. I'm using quotation fingers for those of you who are audio-only listeners. I think his total assets under management are about $5 million. Now, maybe that's grown a little bit in this bear market. Boy, it ought to have grown some during a bear market, right? That's what these guys are hoping for all the time, every year. They think there's going to be a big macro downturn, and they're getting it this year, so they ought to be making hay while the sun shines. What's this tweet say? It says, so Tesla SG&A was exactly $961 million in both Q2 and in Q3, despite selling 90,000 more cars in Q3. LOL. Coincidence, mistake, or fraud? Pick one. So that's the kind of quality content you get if you follow Stanfill Cap. No thought, no examination, no analysis. Just, hey, these two numbers were the same, so that can't be right. It's got to be fraud. And the last two tweets here come from Gordon Johnson at GordonJohnson19, longtime Tesla hater, longtime Tesla detractor, not a short seller, but because he's an analyst and he makes stock recommendations. Famously, he had a price target on Tesla that would today be about $7 if you adjust it for the stock splits. So he tweeted, hey, Elon Musk, this seems impossible. It's impossible. Can you explain this? How is this possible in reality? Are these gap numbers? Thanks. So what's in his table down here? He's comparing the most recent quarter, third quarter of 2022, against the third quarter of 20. And this is just some of the numbers that he pulled off of the earnings letter. Store and service locations up 56%, mobile service fleet up 96%, cars delivered up 146%, SG&A up 8%, 8.2%. And then in red over here to the side, he's noted an 8% increase over 2 years despite inflation. And then in all caps, really? Question mark. So the flaw in Gordon's analysis here is that he hasn't done any analysis. He hasn't dug into what were the components of this number or this number to see what was in them and to see if the subcomponents make sense on their own. And if they do, then the sums of those components also make sense, which we'll get to in just a minute because I have done the work for you. Never fear, Tesla Q. as usual, I am here to do the homework you refuse to do and share the answers. And somebody pointed out he needed to back out the stock-based compensation, which is a very important component of SG&A. And Gordon says, for those of you who say adjust out stock-based compensation, I say no you don't. This is a non-GAAP BS accounting trick used to make things look better than they actually are, i.e. were those same folks paid in cash, it would flow through SG&A, so should SBC. Well, he's right that it should be part of SG&A. Nobody told you that you should that the GAAP accounting rules are wrong and that stock-based compensation shouldn't be a component within SG&A. We're just telling you, look at them first and then decide whether that explains the anomaly that you're concerned about. So here is a link to a tweet. Let me open this up. All right, so this is WholeMarsBlog. Let me move this a little bit. And I'm going to need to zoom in here, aren't I? So you can have any hope of reading this. There, that's a lot better. So WholeMars Catalog tweeted, numbers so good the bears don't believe they're real. That's true. So I had to reply to that. How is that possible? Indeed, WholeMars said. And then I replied, maybe if Gordon followed me instead of blocking me, he does block me and has for many years, he would know that Elon's stock-based compensation expense peaked in Q3 2020 and has now almost all been expensed. This chart shows how much expense hits the income statement per quarter related to the performance plan Elon Musk has been working under as CEO since 2018. It's a 10-year plan, and he has already earned all of the compensation possible under the plan. It only took him, 4 years to earn 10 years worth of compensation. Almost all of the maximum $2.283 billion expense that can hit under this stock compensation plan already has hit. So what do we see here? That's actually a pretty good look at that. Maybe I can move it a little bit. Yeah, that's pretty good. All right, so what are we looking at here? This is how much expense has hit Tesla's income statement every quarter since Elon Musk entered into this compensation plan back in 2018. There's 2018. So at first, these were small amounts. Now, if the amount had been spread evenly over a 10-year period of time, it would have been like $60 million-ish per quarter for 10 years, right? But that's not how it goes. The GAAP accounting rules say the more progress you're making towards achieving the performance goals outlined in your plan, the more expense needs to hit the income statement because you are earning that portion of the total compensation possible under the plan. So that's what was going on here. In 2020 and 2021, Tesla's market cap was appreciating as the stock price was skyrocketing back here from, 5-year lows in 2019 Q3 to all-time highs by the end of 2021, right? So these, and the company was making progress towards the revenue and EBITDA goals that were outlined in the plan as well. So that's why so much more expense was hitting the P&L 2 years ago than is hitting now. There are very tiny slices indeed here. So what I'm using for the purposes of this video are my estimates for stock-based compensation because this amount of detail isn't out until the 10Q is published. But I feel like my numbers are close enough to use for right now, especially since for Elon's stock compensation plan, there's almost nothing left that could be expensed under this plan. Okay, so that's that one, and then I will open up my Excel spreadsheet and show you a chart that helps you understand this even better. This is an operating expenses chart, which includes restructuring and other and research and development, as well as the 3 largest components of SG&A that we get detail on in the 10Qs. So restructuring and other, the yellow one, doesn't even happen every quarter. Some quarters it happens, some quarters it doesn't happen, right? So last quarter it did happen, and this quarter it did not happen. So if you throw out the restructuring and other, which was including like layoffs that Tesla did earlier this year, well, that's one of the reasons why your SG&A wouldn't be increasing by as much as inflation, because you laid off a lot of people who were previously hitting SG&A, and they don't work for Tesla anymore in Q3 of 2022, right? Engage your brain, think through what do we know about Tesla's expenses, how has that been changing over time, and use that information to draw conclusions rather than just looking at the total amount, right? So the stack of these bar charts in total is the total amount of operating expenses. It'll be even cleaner on the next chart that we look at, but this one also includes research and development. That's the light blue one down here. So you can see it, hopping around a pretty good bit for research and development. But mostly growing over time, nothing suspicious or fraudulent looking here, right? So those are the two components I'm about to drop, the restructuring and other and the research and development. And instead, we'll look just at the SG&A. This is what the SG&A looks like all by itself. So here was that Q3 of 2020 that Gordon Johnson was complaining about, Q3 of 2022 not being very much more than. Well, look how big this green block was back then. That's how much Tesla was expensing related to Elon's stock compensation plan back then. That huge bar. Look how big that green bar is now. It's so tiny you probably can't even see any green on your screen unless you've got like a 4K TV or something, right? I mean, it's very, very small now, and that's the explanation. What's been happening with the other ones? Well, these darker blue ones, this is other SG&A stock compensation for other people who work at Tesla besides Elon Musk and whose expense hits SG&A. They're here. What about this other one? It looks totally normal, all except for Q4 of 2021, which people have also been comparing against, not remembering that in this quarter there was $340 million worth of payroll expense Tesla owed related to Elon exercising stock compensation under his 2012 plan that he was exercising shares on. So they owed payroll taxes of $340 million during this quarter. And that's why expenses have been lower since Q4 of 21. What else did I want to talk about? Let me go back and look. Okay, so the core accusation here from Mark B. Spiegel is that Tesla's selling more cars, so their SG&A should have gone up. Well, no, that's not how that works. Selling more cars hits your P&L as cost of goods sold expense. The costs related to your factories, ramping up factories, buying raw materials and parts and producing cars, hits in the cost of sales expense items above gross margin, right? Not in SG&A. That's not a valid point to make about SG&A not increasing from Q2 to Q3. As we've seen, the explanation for this is that there were layoffs in Q2, and some of the people who worked at Tesla and whose severance packages hit as restructuring and other in Q2, there was no expense associated to them in Q3. And the accusations here from Gordon Johnson are of a similarly erroneous line of argument. Hey, your store and service locations are up. All right, that doesn't hit SG&A. That hits services and other expense. Your mobile service fleet is up. That's not SG&A. That hits services and other costs of sales. Your cars delivered are up. That doesn't hit SG&A. That hits cost of goods sold. That's cost of sales expense. Your SG&A is up 8% since the third quarter of 2020, but you now know the reason for that is that the stock-based compensation expense from Q3 of 2020 did not occur in Q3 of 2022 to anywhere near the same magnitude. And that's the explanation. If only these short sellers would do half the work Loki does, and Loki spends most of his day sleeping. Alright, that's my video for today. If you've enjoyed today's video, click the like button. If you're not subscribed to my channel already, you could go ahead and click the subscribe button. If you're interested in supporting the work that I do, there's links in the video description to Patreon, or you can join my YouTube channel. Each of those come with benefits. Like on Patreon, you get early access to videos the day that I upload them instead of having to wait for me to tweet them and make them public. And big shout out to Kathy Kitchler, my executive producer, and I'll see you in the next one.